In a world where fortunes rise and fall in the blink of an eye, the skills you choose to master today will echo across the decades. The choices you make, the mindset you cultivate, are the forces that can shape your entire financial destiny. Whether you're just starting out or well on your way to becoming a financial powerhouse, the tools you invest in today are the foundations of tomorrow's success. When it comes to investing, understanding how to navigate the landscape can mean the difference between financial growth and missed opportunity. In this video, we will unlock the blueprint that has guided countless investors to greatness. It's a framework that spans every type of economic environment, a system designed to help you evolve in your journey toward true wealth. And stay with me until the very end, because I'll be revealing the most important insight that ties it all together, a principle that can transform how you think about investing for life. Welcome to Financial Thoughts, where we're not just talking about making money, we're inspiring future billionaires. If you're ready to elevate your mindset and master the art of financial growth, you're in the right place. Don't forget to like, subscribe, and turn on notifications, so you never miss a moment of this journey towards wealth and wisdom. The strategy we'll explore today goes far beyond individual stocks. It's about understanding the different pathways to wealth and finding which one speaks to you. But more on that later, as the most crucial lesson awaits at the very end. 1. Growth stocks. Growth stocks represent companies that are expanding rapidly, often reinvesting their profits into the business to fuel further expansion rather than paying out dividends to shareholders. These companies typically have higher price-to-earnings ratios, reflecting their potential for future growth. The appeal of growth stocks lies in the possibility of significant capital appreciation, as investors are betting on the company's long-term trajectory rather than its current earnings. However, this potential for high rewards comes with elevated risk. Growth stocks are more volatile and sensitive to market shifts. This stock type requires a forward-looking mindset, where you are investing not in what a company is now, but in what it could become. Take Amazon as a prime example. For years, Amazon didn't generate large profits but reinvested heavily into infrastructure, technology, and global expansion. Investors who believed in Amazon's long-term vision were rewarded handsomely as the company eventually became a dominant force in e-commerce and cloud computing. Similarly, companies like Tesla also fit this mold, focused on future-oriented innovations like electric vehicles and sustainable energy, rather than current profits. While these stocks can soar when the company performs well, they can also experience sharp declines if growth expectations fall short, making them a high-risk, high-reward option. 2. Dividend stocks. Dividend stocks, on the other hand, are typically established companies that share a portion of their profits with investors through regular dividend payments. These are often mature businesses with stable cash flows, prioritizing steady income generation over rapid growth. For many investors, particularly those focused on generating passive income or preparing for retirement, dividend stocks offer a reliable source of cash flow. Investing in dividend-paying stocks also provides a cushion during volatile markets, as regular dividend payments can help offset dips in stock prices. Consider Verizon, a telecommunications giant, as an example of a dividend stock. While the stock price may not experience the same dramatic gains as a growth stock, Verizon offers consistent, attractive dividend payouts that appeal to income-focused investors. Another example is Coca-Cola, which has been paying and increasing dividends for decades. The company's dominance in the beverage market allows it to provide investors with stable returns. These stocks often appeal to conservative investors looking for reliability, making them a pillar of many long-term investment strategies. 3. Blue chip stocks. Blue chip stocks are large, well-established companies with a history of solid performance, often commanding a leadership position in their industries. These stocks are considered stable and profitable, making them a favorite among investors seeking both capital appreciation and income. Blue chip companies typically have a robust balance sheet, strong management, and the ability to weather economic downturns. For this reason, they are often viewed as a safe bet in uncertain times. While they may not offer the explosive growth potential of smaller companies, blue chip stocks provide steady returns and are known for their resilience. Think of Apple or Microsoft, both titans in the tech industry. These companies have not only grown exponentially but have also demonstrated their ability to adapt to changing market conditions and continue delivering shareholder value over the long term. Johnson & Johnson is another example, an established pharmaceutical and consumer goods company with a consistent track record of profitability. Blue-chip stocks are the cornerstone of many portfolios, especially for investors looking for a balance between risk and reward, as they offer both growth and income stability. 4. Cyclical stocks. Cyclical stocks are companies whose performance is closely tied to the overall economy. These stocks tend to perform well during economic expansions when consumer demand is high but may struggle during recessions when spending slows. Industries that fall into this category include automotive, airlines, and hospitality, which are all sensitive to economic cycles. Cyclical stocks offer the opportunity for significant gains when the economy is booming but require careful timing, as they can also experience sharp downturns in periods of economic contraction. Take Ford, an automaker whose sales and stock performance are highly sensitive to economic conditions. In times of economic growth, consumer demand for cars rises, boosting Ford's revenues and stock price. However, during recessions, auto sales tend to drop as consumers delay large purchases, leading to potential declines. Another example is Marriott International, a leading player in the hospitality industry. When the economy is strong, travel demand surges, benefiting hotel chains. But in an economic downturn, travel is often one of the first expenses people cut back on. Investors in cyclical stocks need to have a good sense of the broader economic climate to make well-timed investments. 5. Defensive stocks. Defensive stocks belong to industries that are less affected by economic cycles, offering stability even during downturns. These companies produce goods or services that consumers continue to need regardless of the economic situation, such as healthcare, utilities, and consumer staples. Defensive stocks are seen as safe havens in uncertain times, as they tend to provide consistent returns and dividends, making them an essential part of a balanced portfolio. Investors often flock to defensive stocks during periods of economic uncertainty to preserve capital and maintain income. For example, Procter & Gamble, a consumer goods company, sells essential products like household cleaning supplies, personal care items, and baby care products. No matter how the economy is performing, people still need these everyday essentials. Similarly, Johnson & Johnson fits the defensive category within the healthcare sector. People continue to require medical supplies and pharmaceuticals in both good and bad economic times. Defensive stocks provide a shield during market volatility, ensuring that your portfolio maintains some level of stability when other sectors may be struggling. 6. Speculative stocks. Speculative stocks are high-risk, high-reward investments, typically from younger or smaller companies with significant growth potential. These companies may not yet be profitable or could be operating in industries with unpredictable outcomes, such as biotechnology or cutting-edge technology. Investors in speculative stocks are willing to take on greater risk in the hope of realizing substantial returns if the company succeeds. However, these stocks can be extremely volatile and are not suitable for conservative investors or those unwilling to risk a potential loss. A prominent example of a speculative stock is SpaceX. Though not yet publicly traded, it represents the type of company many speculative investors are drawn to. It's a company with enormous potential in space exploration but comes with inherent risks due to the unpredictability of the industry. Similarly, Nvidia, in its earlier years, was considered speculative as it was betting on the rise of graphics technology and artificial intelligence. While it has since grown into a much more established company, early investors who took the risk reaped huge rewards. Speculative stocks require careful consideration, as their potential for high rewards comes with an equally high risk of failure. As we've explored today, understanding the different types of stocks is not just an exercise in financial literacy, it's a crucial step in shaping your future. Each type of stock offers its own unique potential, whether you're seeking growth, stability, or even embracing risk. By applying these insights, you empower yourself to make more informed, strategic decisions that can lead you closer to your financial goals. Now is the time to take what you've learned and begin building a portfolio that reflects both your ambitions and your risk tolerance. Remember, the key to successful investing is aligning your strategy with your long-term vision, while staying adaptable in the face of an ever-changing market. If you found this valuable, there's much more to discover. Be sure to check out our other content where we dive deeper into financial strategies that will help you on your journey to becoming not just a millionaire, but a financially empowered individual. Don't forget to like this video and subscribe to our channel so you never miss out on the insights that could transform your financial future. Because in the end, when you transform your thoughts, you truly transform your life.